So if there are any questions, ask them as we go along. Don't specifically wait to the end. So we're talking here about optimizing a property portfolio. So this is mainly addressed to people that have already got, let's say, at least one property, or maybe got two, three, or more properties. It's really important to not just like sort of sit on them and forget about them and take whatever income is coming, but it's an active, not a job, but it's really important to review what's happening and take action to optimize the portfolio. So we're going to go straight into the presentation. So introduction on how to optimize a property portfolio. So why is optimization essential? Obviously, for improved income, reduced risks. So part of the optimization on a portfolio is doing from time to time a risk analysis. We'll see what it is. And yeah, optimizing for long-term growth. So what do we get from this? Clarity, better decision making, and increased profitability. So how does this work? When we're looking at optimizing a property portfolio, we need to understand what our goals are, and we're going to optimize it with respect to those goals. And generally, there's two goals that can run together, but either we've got a really important focus on regular and reliable income, so monthly cash flow. This can be really important for people that have decided to replace their work income with property income and are either got past that level or are at the point where they're going to stop their normal work, well, previous work, let's say their job, and rely on their property income. There obviously is needed to be extremely careful on top of the monthly cash flow. And then there are those who are more concerned about, let's say, buying the right properties and almost like stocks and shares, but much longer term. And obviously, property is more stable than stocks and shares. If the goal is capital appreciation, so increasing the value of the property there, the reviews are going to be more focused on how has the value of the property increased, still making sure that it's cash flowing, what are the potential for the future. And if we maybe got, for example, properties in an area which has had high capital appreciation, based on different factors, is unlikely to increase much over the coming years, we might decide to sell and invest elsewhere. So first of all, we need to know what our objectives are, so that when we're reviewing the portfolio, we can do the necessary optimizations. Key financial metrics that we need to track. So here are like some of the obvious ones: the monthly income, which is what we call the gross rent, all the monthly operating expenses. So these are repairs, management fees. If we happen to be operating serviced accommodation or HMOs, then that's all the utilities, cleaning costs, all the costs associated with running those operations. We need to be tracking our monthly mortgage payments and the interest rate. And if we've got mortgages that are on fixed rates up to a certain point, we need to have in mind the dates at which those fixed rates are going to be finishing. And then, yeah, understanding the true monthly net income. Almost like, especially if you've got a few properties, almost like a business, a well-run business will have management accounts, and every month we'll have key performance indicators, which are indicating how the property is, how the business is performing, so we can take corrective action. Then we've got some digging deeper and looking at some additional things. This is like more tracking the overall costs of money that we spent on property, tracking how the properties have increased in prices. So we're going to be tracking and looking at the original purchase price, stamp duty, and legal fees. As an aside, all the items mentioned here on the balance sheet of a company, if the property is owned in via a company, all these are part of the assets on the balance sheet. So if we're selling a property, the capital gains, we're taking into account the purchase price, the stamp duty, legal fees. We're generally taking into account, then we've got like the total refurbishment or improvement costs. And then we should be tracking what's the current market value for our properties. And there is a difference here. When we're looking at current market value, we've got a market value which is used for refinancing a property, and then one that is used for selling a property. Theoretically, the sales price should be similar to the value used for refinancing. Sometimes it can be more, but there can also be conditions, like market conditions, where almost like at the moment, sometimes in some areas, market conditions are not great for selling. So we can in practice end up with higher values for refinance, because the refinance values may well be based on, for example, sold prices over the last 6 months or 12 months, and don't completely reflect the immediate reality of maybe a dip in the market. And if that's the case, sometimes we might think at the moment it's better to, if we've got equity available in our properties, better to refinance rather than try and sell. And then to always have these figures available. If you've got 1 or 2 properties, we should have them in our heads. If we got 5, 6, 7 or more, then our Excel file is tracking all of this. And then this is an important thing as well. It's to actually conduct, I would say at least once per year, a risk and what I call a risk and compliance review. So there's a few things here. First of all, it's ensuring that all our properties are legally compliant. So making sure that we've got EPC, gas safety, ICR, if we're operating HMOs or serviced accommodation, to make sure that we've got all the fire safety things in place. That if it's an HMO as well, there has to be the regular the monthly, obviously the monthly tests of the fire alarms, the 6 monthly tests of the emergency lighting, and yeah, basically the monthly visits that are checking that the tenants haven't blocked fire exits or haven't left flammable things in the wrong places. Yeah, so even if like here, so it's saying self-managing versus using a letting agent, are they compliant? If we're self-managing our tenants, obviously that's a lot more complicated, and especially with the new renters rights bill coming in place, there's going to be a lot more things to make sure that are compliant. So there on the risk and compliance review, if we're not using an agent, then to make sure everything is completely up to date. And if we're not using an agent, I strongly recommend being part of an organization like, for example, the National Residential Landlords Association or other ones that can provide both checklists of everything that's needed to do, can provide, for example, templates for the different contracts, and generally also they'll have a legal helpline when there are questions. So yeah, if self-managing, there's a lot of stuff to review. And even if using a letting agent, make sure that the letting agent is compliant and following all the procedures. Because if a tenant stops paying and the court orders some rent repayments because some things weren't up to date, at the end, it's the landlord that's responsible, even though potentially you can go back to the letting agent and take them to court. It's much better making sure that you've got a good letting agent that is compliant. So yeah, reviewing these risks is important. Then we've got the tenant risks itself. So that are risks of tenants falling into arrears. And then, yeah, considering based on those risks, whether it's needed to have and whether you got in place rent protection. And then also a regular, when I say regular, by the way, generally we're looking at doing this at least once per year, but doing it really exhaustively once per year. And then if we were doing it for the very first time, then we might take a bit longer to do it. And then each year we're going through this and checking everything. Yeah, so considering liability and building insurance, potentially contents insurance if it's HMOs or serviced accommodation, and also at the same time reviewing current legislation to understand if there's any different or additional insurance that the law requires us to have or that is advised. So this is our risk and compliance review. Then we've got our review of maximizing the net income. So we've already spoken about, yeah, we'll start actually with this one here. Review rent levels, are they in line with the market? And now that's important to do annual rent increases up to market rent. And especially now with the Renters' Rights Bill, it's only possible to do rent increases once per year. So to make sure that those are in a schedule and that you're effectively doing them. And based on what the objectives are, if the objective is primarily cash flow, for example, to replace work income, then consider models which give higher income, obviously higher levels of work and compliance as well, such as HMOs, so renting out by the room, or serviced accommodation, which is like Airbnb, Booking.com type things. So we've got those two ways of maximizing the net income and then also maximizing the net income. The net income obviously is the gross income, so what the tenants or guests are paying minus all the costs. So to optimize the net income, it's also optimizing, reducing as much as possible the costs. So when we do our annual review, we're going to be looking at insurance costs. We're going to be looking at management costs. Is the managing agent that we're using competitive? Is it time to maybe look for a different one? And also, yeah, optimizing maintenance costs. So what maintenance company are we using, or who the maintenance people that we're using, is that well optimized? And then the fourth thing to look at is obviously mortgage payments are an important or significant part generally of the monthly costs. So is it possible to switch to a better mortgage product and to do the calculations, even when there are early repayment charges in place? Sometimes it can be better to switch to different mortgage products, and especially if property prices have increased. So it's possible to take equity out of the property, so to remortgage at a higher value to take money out if the aim is to continue to increase the portfolio and the ongoing income. Then this is it's actually a difficult one, but it's sometimes like an emotional one. You bought a property maybe 10 years ago. Maybe it was the first property you bought, and obviously it's always good to get into property to start with something. But at the same time, it's not always good to hold forever if it's possible to sell and reinvest and get more income, especially if the aim is cash flow. If someone has properties in a expensive area, like for example in London, so that obviously means low yields. We might have yields of 2, 3, or 4%. There obviously it's worth considering selling them and investing in areas where the yield will be higher. if the aim is more capital appreciation, maybe it's fine to hold them, but to carefully evaluate that. And the key thing is to, I was actually discussing this with Nick earlier, is to remove emotions from the equation. Not to think I bought this property, this was my first property. Maybe you even spent some time doing the DIY in there and part of the renovation. But look at it as an investment and look at it, is it a good investment to keep, or is opportunities to sell and get a better return on the money that you release from the property? Yeah, so that's the thing. Could capital be better used in higher yielding locations? And then the third thing, consider selling poorly performing properties. And it's a bit like, yeah, poorly performing shares. You might have bought shares in some, unfortunately, this is my case because I'm not at all expert in stocks and shares, and I've only done like a bit of dabbling on the side. But I've got some shares that are like 80% below the value at which I bought them. And I'm like sort of thinking, well, what's the point in selling them? Even if I could maybe get 10 or 20,000 out for them, I'm thinking, what's the point? Because maybe one day they will miraculously recover. I'm not an expert, and in practice, it's probably for quite a lot of them, it's unlikely ever to be the case. And the same thing with properties. If you got some good income from it, but it's no longer suiting the purpose, consider selling it. And then the fourth thing, properties that are owned in personal name, especially if they have high mortgages on them, also consider selling them. Obviously, we need to take into consideration the capital gains tax, because if properties are in personal name, when we sell them, we've got that capital gains tax to take into account. But at the end of the day, that should be on taking the emotion out. That should be on the Excel file. So it's saying this is the value of the property. If on this day one, we sell, pay the tax, reinvest in a different property through a limited company, we do our projections for 1 year, and then generally we're doing for 5 years as well. And we make the comparison. And if the figures realistically calculated show that we're going to get twice the income and potentially higher capital appreciation over those 5 years, then go ahead and do it. This is a slide sort of put in there as something for consideration. Especially sometimes people have started doing things and thinking that property is easy, especially some of the high management things like HMOs or serviced accommodation, or even quite simply dealing with tenants. And when you take into account that if you're going to have it managed properly, it's going to be 15% management fee, and at the end of the day, it's not really bringing in much income, then yeah, there's two possibilities: sell and either reinvest directly in something which is going to have a higher income, or potentially invest part of it in a joint venture with experienced developers, because typically returns are higher on these type of project, and obviously sharing risks and rewards. So full portfolio analysis and action plan. Obviously, we're not going to go into any detail on this, but what I'm saying is, for example, in my case, we've got maybe a dozen properties. So I'm probably not doing 2 to 3 days for a full review, more because or like every month I like to see what's the income, what's the situation. So I'm generally taking action almost all the time. And of course, I can't be teaching about investing in property and optimizing property portfolios if I'm doing it every 3 years myself. But if you're like starting for the first time, for this number of properties, you're probably going to be spending 2 to 3 days. Maybe it might be one day to collate all the information, get all the figures onto an Excel file. And then, yeah, it's like running the metrics, the ones that we put at the beginning of the presentation, understanding what the real situation is, identifying those which are not performing well, what are the opportunities, and making what we right here, data-driven decisions. And then when we've done it once, we're going to be doing an annual property portfolio review. So that's scheduling, yeah, yearly, like checking, running through everything, updating valuations, rents, mortgages. Yeah, and thinking on, yeah, what's working, what isn't working, and taking action, not before it becomes too late, because in general, it's never too late unless you got like bridging that you need to get out of or things like that, or if you end up in um, either negative cash flow or negative equity, then obviously it's needed to take urgent action and yeah, determine what to do and get on and do it. And then, yeah, questions and answers. So for everyone that's watching this or looking at the recording, ask yourself the at least one question. What's one action that you'll take this month? And then the other comment here, some people don't need it, they're fine doing everything themselves. Other people maybe don't have either the experience or the motivation to really go through everything. So here we're saying, yeah, consider joining a peer review or property mastermind. It could quite simply be, yeah, um, paying someone to do a complete review of portfolio for like a one-off action, or it could be ongoing thing if the aim is to really grow a portfolio and significantly optimize everything. So that's the main content. Are there any questions? So it seems like there are no questions. So we can all yeah, have an early finish today, and the recording will be available. It'll be posted on the group and on YouTube probably tomorrow morning.